Some people say that the only thing that works in trading is buying low and selling higher, and some say that such approach is like trying to catch a falling knife and that the trend following is a much better option. Where is the truth though? To find out, I will take both trading approaches, so the one that aims to buy low and sell high, and the one that buys high and tries to sell even higher, optimize both of them to pick the best candidates and compare the results to see which one is a better option. If you're new to my channel, my name is David from Critical Trading, and I publish high quality technical trading videos where I backtest and quantify various trading strategies and tools to provide you with inspiration for your own trading. If that's something you're looking for, then subscribe to my channel to get notified when I publish a new video like this one. Let's start with the first approach, buying high and selling higher. This approach is a simple trading logic of buying when the stock has already made a considerable move, where we speculate that the move will be sustained and the stock's trend will continue, where obviously we speculate that we then sell the stock at a higher price. This approach is very common and is a building block of many trend following and momentum type trading strategies out there. I myself trade systematic strategies that are based on this logic. For the purposes of this video, I'm going to test a simple breakout strategy that trades all Russell 1000 stocks and opens a trade when the stock breaks above a highest price high over a certain time period, such as 100 days for instance. What I'm going to do is I'm going to run a simple optimization of the period of the highest high, where I want to find out which highest high length performed the best in the past. Now, there are some specifics that relate to optimizing the parameters of trading strategies like this that make the process a little more complex than what I do here. However, this video is not about optimization, so I'm not going to touch on that here. I've got the results of my optimization of the highest high length shown on the screen. I ran the optimization in the software that I use, Broker, and I've run the optimization to start with the 20-day high up to the 500-day high breakout, increasing the length by 20 days. For each of the tested length, I got the results that I'm showing here on the screen. For each of the variants tested, I've got all performance metrics, such as the average annual return that's shown in this column that I've just highlighted. Then I've got the maximum drawdown of that variant and so on. For the purposes of this video, I'm going to pick the ratio between the average annual return and the maximum drawdown for each of these tested variants, which is what I've just plotted in the form of a line chart. Now, what this chart shows is the ratio between the annual return and the drawdown for each of the variants of the system. Each variant differs in the highest high length that's used for the breakout. When the stock closes above the highest high, system buys the stock. Individual highest high lengths are shown on the horizontal axis, so starting from the breakout of 20-day high up to the breakout of the 500-day high. The return to drawdown ratio is shown on the vertical axis, where obviously the higher the ratio is, the better. The best performing variant of this simple breakout system that buys high and sells higher is the one that uses a breakout of the 440-day high to buy the stocks. For the purposes of this video, let's take this particular version of the system further. However, as I said, optimizing systems needs to be done a little differently to this. It needs to be done on what's called an in-sample and out-of-sample data to minimize the risk of overfitting the strategy. Now, let's have a look at a sample trade of this system. The 440-day high that we picked based on the optimization is plotted on a chart in turquoise color, where we can see that on this particular day I've just highlighted, the high was broken and so a valid buy signal gets generated. For the purposes of this video, I will test this system with a simple 10% trailing stop loss, which is plotted in a form of an orange line. The stop level gets hit here on the day I've just highlighted and the position is closed. Overall, a super simple breakout system that does the opposite of buying low and selling high. It buys high and aims to sell even higher by exploiting the momentum phenomenon that's been present in the markets for decades. Now, let's do the same optimization exercise for the breakout of the lowest low instead in order to quantify the opposite logic, buy low and sell high. To test this, I'm changing one rule only, and that is the breakout level. Instead of buying when the market breaks above the highest high, I'm now saying that I want to buy when the market breaks below the lowest low instead. To compare like to like, I optimized identical lengths, so again starting from 20-day low and ranging up to the 500-day low. The optimization results of this buy low, sell high trading logic are plotted in form of an orange line, and they are pretty interesting. We can see that there seems to be a mirrored tendency here. As the length of the breakout level increases, the blue line, which is the highest high breakout logic, performs better, whereas the lowest low breakout logic performs worse. The best performing setting of the lowest low breakout system is actually the shortest, so 20 days. This period is, on the other hand, the worst performing one of the highest high breakout system, which is the blue line. To me personally, these results confirm a couple of things. One is that the momentum in the markets provide an edge based on which one can develop a trading system, which can be observed by the blue line increasing as the highest high breakout increases as well. Second, the fact that the shortest length of the lowest low performs the best when buying the breakouts of lows confirms the mean revertive nature of the stock markets across shorter time horizons. Both the momentum and mean reversion can be used as building blocks of trading strategies, but one definitely needs to pay attention to the time horizon. Let's have a look at the model trade of the best performing lowest low breakout system, the one that buys Russell 1000 stocks when the stock closes below the 20-day lowest low price. Again, the price level used to time the trade is plotted in turquoise color, where we can see that the level got broken on the highlighted day, meaning a buy setup got generated. To compare like to like, I'm using an identical exit technique to what I used before, so exit at a trailing 10% stop loss, which is plotted in a form of an orange line. Market hit that level on this day, meaning that the position was closed. And now let's have a look at the equity curves and the backtest results of these two simple systems. The turquoise line is the best performing variant of the system that buys the stocks at the breakout of the highest high, 440 days to be precise. The orange equity curve is the best performing variant of the system that buys the stocks at the breakout of the lowest low, 20 days. Both systems tested from 2003 on all Russell 1000 stocks, taking the historical index constituents into the account, and both systems use the same exit, 10% trailing stop loss. On top of this, both systems use a simple index filter that's based on the Russell 1000 index and only trade when the index is above its 200-day moving average. We can clearly see that despite the orange equity curve is far more volatile, both trading approaches seem to work and can provide a foundation for a trading strategy. A clear pattern that emerged out of this test is that the longer term periods seem to work better for the momentum type systems, such as the one that I tested here that buys when the market breaks above a certain price high. And conversely, shorter term periods seem to work better for buying the breakouts of price lows instead, confirming the mean revertive nature of stocks over short time horizons. Buying breakouts of longer term price lows led to losses in the tests I conducted. The actual results do not differ that much when it comes to the profitability. We can see that the annual returns are similar. However, the drawdown figures differ significantly. The logic of buying high and selling higher has nearly half the drawdown of the buy low, sell high logic. What I wanted to demonstrate in this video today is that both trading approaches can work, and you can use both buying high and selling higher and buying low and selling higher as a basis for your own trading strategies. However, what I recommend to focus on with whatever you decide to take further is the time horizons. As we've seen in this video, buying breakouts of the lows seems to provide an edge over shorter term horizons, whereas the opposite applies to buying breakouts of price highs. Thank you for watching. David at Critical Trading, signing out.